Thank you very much, everybody, for joining us today. Wherever you are in the world, welcome along. Very much appreciate you all taking your time to listen to Phil and I. So, as you would have seen from the invite, we're going to be talking about a number of different things today, with a little bit of a focus on London. It was quite some take up actually when we put the adverts, put the link out there for everybody to join. It's obviously touched a little bit of a nerve. But London, I suppose, is always popular, isn't it, Phil? So today we're going to talk about the London market in particular. One of the questions we get asked all the time is, have prices dropped? Is there a crash? Will there be a crash? These sorts of things. It's a good opportunity, obviously, now as well to introduce Philip Rines, founder and managing director of Brick Management and Lettings. And so the second point on this list is very much your bag, and we'll be talking a little bit about the London sort of markets from a rental perspective. And that question, how fast they're rising, is a very topical one, because I think it's fair to say they're rising pretty fast. We're going to a little bit of a look generally at sort of the outlook moving forward, and also we're going to talk a little bit about a new development that we're launching as a good example of what a typical London buy-to-let or a good London buy-to-let looks like. So Phil, just quickly, I'll just give you a moment just to introduce yourself, if I may.
Thank you, Richard, and thank you for everyone for joining us today. As Richard highlighted, Brick Management and Lettings, based in the UK. We specialise in portfolio management for UK assets, residential. We offer a nationwide sort of portfolio service. So we have properties under our management from the south coast all the way up to sort of Newcastle and anywhere in between. As Richard obviously asked earlier on, I'm currently find myself based in the Midlands in Birmingham today, following another scheme that we've just taken through. For ourselves, we do everything in-house, and we're highly experienced. I've got a great team behind it, and I'd look forward to sort of running through with you a little bit about the rental market in the UK, and obviously more specifically to London.
Very good, thank you, Phil. So one thing I should also just highlight at this point is there is a Q&A button where you can type in questions that you may have. So please feel free to put them in there. We usually get asked the same questions more than once, so put them in, and we'll do our best to go through them all. And we can, to some degree, we can do that as we go. So please do put them in. So I think before we go any further, it's probably worth just putting the UK market into a little bit of context. We've obviously had, I think it's fair to say, a weird few years, right? In a way, it feels like 2020 and 2021 didn't really exist because we were all just at home and not doing very much. The property market at that stage was not, I think it's fair to say, a normal market. The type of property people were buying and renting changed pretty dramatically. There was the so-called race for space as people looked to move out of the cities and into more sort of countryside locations where you might get more for your money. There were obviously lower interest rates, stamp duty holidays, help to buy, all these sorts of things contributed to it not being, I think it's fair to say, a particularly normal market, but a market that did lead to some pretty impressive growth. Over the last 10 plus years, we've seen the north of England bloom, as investors have chased yields. I've already mentioned the race for space in the south. But today, and it was sort of kick-started by this infamous pair on the right-hand side, Liz Truss and Kwasi Kwarteng. The situation we find ourselves in today of with inflationary concerns, interest rates being pushed significantly from a low of 0.1%, and we're now, I think we're now sitting at 4.5, and there's talk of potentially 1 or 2 more raises still to come. And we've also had tax changes in the way that income tax and acquisition taxes like stamp duty are treated. So the market today is a very different place to where we were even 12 months ago, 18 months ago, quite frankly. And so, you know, and with everything that is out there, and particularly the interest rates, you would be forgiven for asking the question. And actually, to be honest, you could just read any number of headlines towards the end of last year, and you would have thought we're about to, or moving into, the worst period in property sort of history, if you like, in the UK market. This is, I'm pleased to say, just simply not the case. There have been price drops in localized locations throughout the market, but generally generally the UK market or the property market in particular has been notable for its resilience. There has been, I mean, this is taken from a Savills report at the end of Q1. There has been significant growth across, you know, virtually the entire country, with the interesting exception of London. We'll come back to that in a second. With, you know, coastal regions, the Northern Powerhouse, Midlands have all performed especially well. In Q1 of this year and the last 12 months or so preceding that, there have been, by and large, some minor reductions in price in that period. But again, given the headlines, I mean, I think it's fair to say, Phil, some of the headlines we were seeing back in November, December, January, you know, I'm absolutely delighted with the numbers we see here, quite frankly.
No, definitely. I think there was an element of the shock value initially when it first come through, and certainly, as you say, you know, being on the ground as such, you know, the confidence and the appetite still does remain. And when you speak to agents and such, like, you know, for good properties, there is still very much a market. You know, properties are selling quickly, and you know, probably more so than ever, you know, in London. Yeah,
absolutely. And that's a nice little segue. You know, we're focusing today on London for a reason. So if I just sit back actually slightly to this, what you will see at the top here, that top line, the 3-year growth in London is only 0.2%. In central London, it's actually gone down slightly in outer London. You know, whereas, and then the suburbs, which is what we, this sort of race for space, people moving out of zone 1 and zone 2, have done exceptionally well over that 3-year period. But what's interesting is London as a whole has not performed as well as the rest of the market. But there are some really good signs in London property right now. So we've got, there was some figures out a couple of weeks ago, again from Savills, which were quoting London prices up 2% since the beginning of the year. The average London seller has sold their price for almost full asking price in Q1, and this compares very well to, you know, any typical market situation. The viewing levels are up, and there are fewer sellers in the market. But what is really interesting, we'll come back to this in a minute because it's directly relevant to what your obviously day-to-day is, Phil, with the rents, is that in the last 7 years, there's been a 32% house price rise across the UK on average. London has only seen 12%. And what's interesting about that is that it feels like now might be a good time to get back into London because of the relative value that London is now sort of offering, and particularly when you compare that against the rental yields which are now available. And we'll come back to that in a second, but you know, traditionally, and I mentioned just now the sort of the how the northern cities, Manchester, places like this have performed in the last 10 years, and they've done exceptionally well. And that's because people have been looking for increased yields. With the rental rises that we're seeing and have seen over the last 2-3 years, and particularly the last 12-18 months in London, and the fact that values haven't really risen, suddenly it's now possible to go and buy a property in London again with a 5.5, even slightly more percentage income, which is just, I mean, up until certainly up until Brexit, your yields are more like 3 or 4%. I think it's fair to say, Phil.
No, definitely. As you say, it's I think the sort of the gap between London and the northern cities it's certainly come smaller. It's much more of a level playing field, and yeah, I mean, you're correct. Yields of in excess of 5% now are very achievable.
And I think, and the reason behind both that demand for rental property pushing those yield prices, but also the simple fact that actually, prices haven't crashed. Housing prices haven't used that sort of headline or tabloid headline grabbing word, crash. It's simply because ultimately there are not enough houses being built. What you'll see in this graph here is that across the board, anyone building new property, whether that be private developers or local governments, or we have seen the supply of property diminish dramatically over the last 2 or 3 years. There are now more there's now more completions per annum at the moment than there are planning applications for new units going through. So ultimately, all this means is that this sort of supply and demand deficit is going to continue. It's going to get worse. It's what we saw in 2009-10, which led to a huge boom in London housing, where there were just developers stopped building, stopped acquiring sites because they were worried about selling them, and it led to significant price growth over the following few years. One of the reasons why that happened. And in terms of where these shortages are concentrated, London and the southeast have the highest housing need, which makes sense given it's the highest population. But they also, in terms of that deficit between planning consents and housing requirements and actually how the property is being delivered, it's absolutely vast. And actually, I think this sort of brings us on nicely to your bit, Phil, in terms of the rentals. Maybe you could talk now from a sort of purely rental point of view, what we're seeing.
Yeah, no, certainly. I suppose the rental market in many ways sort of mirrors the sales market in regards to the really sort of imbalance, I suppose, on supply and demand. The shortage of stock, with the shortage of properties being built, with hand in hand comes to a shortage of properties for rental. I mean, certainly in regards to sort of some of the stats out there, I mean, obviously from the census 2011, so over the last sort of 10 or so years, actually the number of renters, so people looking to rent property, have actually doubled. So the actual tenant market for us is twice as large. In that same time, obviously based on the shortage of properties, rents have also continued to increase, and 48% rental increases within that 10 year or so period. It's probably worth noting, like Richard was highlighting, that at the moment, with the lack of perhaps new planning applications and such like, and the physical shortage of property we're seeing on the ground, that within the last year alone, Zoopla have highlighted that actually the rental growth is 17.2%. So it goes to show that the real squeeze that the rental market's experiencing currently.
I think also, just to sort of try and make this relevant as well, the major concern for investors at the moment, and rightly so, is interest rates, right?
Yes.
And why wouldn't it be? Because if it costs you more money to borrow, it does impact on your returns. Yeah. But the mitigation, of course, is the fact that rents have risen.
I mean, for many of our obviously active landlords currently, obviously with the rate increases, maybe that they've obviously been affected with the recent increases and rises, but it's sort of hand in hand. It's sort of been mitigated really by the rental increase. you know, for London, again, it's, you know, documented now that the average rental is sort of in excess of £2,500 per calendar month. So, you know, again, it's, you know, there's healthy rentals to be obtained, and, you know, the shortage of property for us, you know, in real term is, you know, properties come onto the market, and we, you know, we struggle to deal with the inquiries and applicants. You know, it's a real imbalance. I think for the, you know, again, as a, you know, sort of stats come about, you know, that as we find ourselves now, sort of before the pandemic, there's 30% fewer properties on the market, and I think that's probably down to a number of different factors, but because of where we are with a shortage of property, tenants seem to be staying in their properties longer term. They're not giving notice and moving around, or being quite so fluid, perhaps. We've also noticed a big shift in more sort of singular living. So perhaps a 2-bedroom apartment historically would have been a couple of professional sharers. Now it's very common for someone to work from home Monday to, you know, or 3 days a week, and now they'll look to have a second room as a sort of work from home office. That further squeezes that sort of, you know, or dilutes the market, really.
It's quite a rude acronym for the people that stay at home Monday and Friday, aren't they? But I won't say it here. I read it in the Telegraph. In my defence, it wasn't wasn't something I've just made up. And in terms of something else I saw, another figure I saw the other day, the sort of tenants that we're talking about in a typical London buy-to-let. I saw that the average age now for first-time buyers in London is just under 34 years old. So I presume the sort of tenants we're talking about here, the sort of people you're dealing with in these developments, are fairly mature, successful individuals generally.
Yeah, very much so. Very much so. You know, again, for you know, for I suppose sort of the tenant demographic, all professional tenants. It's very common for people to be either in, you know, in IT or, you know, pharmaceuticals or whatever it may be, and, you know, again, as you correctly say, you know, they're senior management roles and such like, but still in the rental market. Tenant.
And in terms of, I see on the screen here, we've got under the consequences, it says rents driven up across the capital as renters move further out seeking more affordable deals. You know, 38% rise in renter registrations in zone 3 to 6. I mean, that's obviously pretty topical and sort of confirms our kind of viewpoint from an investor standpoint. It does seem to me that that's where the mass market is now. It's not zones 1, 2. It's that kind of slightly commuter belt.
Correct.
Right?
Yeah. I mean, we've noticed that sort of a shift actually for people coming out of the you know, central London, you know, in the pandemic. But, you know, having said that, you know, it's returning, but more and more people now are happy to commute on in. There's, you know, the Queen Elizabeth line. You've got all the, you know, good access for the tube network, and people are happy to, you know, to perhaps sort of be out of London a bit, but it's predominantly driven by a squeeze in the rental prices. It's now longer, you know, sort of unaffordable for many. They are
actually we've sorry to interrupt you. We've just had a question actually from someone sort of related to this, you know, so the question is, with rents rising, how would you deal with people not being able to afford their payments and stop paying? So if I can let you just answer that question in a second, because obviously one of the just from purely investment standpoint, before you go into sort of the exact answer, one of the things that we're interested in from an investment standpoint is finding the locations that people are moving to because they're being forced to, because they can't afford £3,000 a month in zone 2 or whatever it might be. And so we are looking at these sort of wider locations like zones 3 to 6. But Phil, with particular regard to that question, is there any ways in terms of ensuring a landlord against sort of, you know, people not paying?
Yeah, I mean, I suppose first off, I mean, you know, for any tenant that uptakes a rental property, there's quite strict referencing criteria to go through. Very similar to, I suppose, if you were, you know, applying for a mortgage. Affordability is critical there. There's an equation that we work to in regards to the level of affordability you would be able to operate on your rent, on your salary. And for ourselves, what we tend to find that most of our landlords will do is there is actually an insurance in place, a rental protection insurance that we provide, which safeguards rental income. So should there be a change in circumstance, job loss, marital split, illness, or whatever it may be, that protection for a landlord is available to them. Should the worst happen and the rent not be met or whatever, it continues as as an income for you, the landlord. What we're finding is that yes, people are moving out, and the outer zones, we're seeing again a very big increase in demands. But in the same breath, because there is such a shortage, there is still the overflow that sort of refills in that do have the affordability. And again, for tenants, a lot of them can be quite senior management roles that have got very healthy salaries that, affordability isn't really.
But you've got to, the truth is, if you're going to pay £2,000 a month on a flat, you need to be earning quite a lot of money before tax to afford that, don't you? So
yeah, but again, for ourselves, I mean, we sort of pride ourselves on the referencing and the qualifying of tenants, and you're correct. There is that is a sizable amount of salary, but there isn't a shortage of tenants with that salary looking for such.
And exactly.
It's it's sustainable.
And the thing is with London, I think people always people have always sort of underestimate how wealthy London is, and the UK generally. There's so easy to get wrapped up in negative headlines, and but the reality is that the UK and London, it's one of the world's foremost cities, one of the wealthiest cities, and there are plenty of people who can afford this. We've actually just a little segue into another question from Divakar. So thank you very much for your question. Related to immigration and how that's impacting property trends. I'm sorry to say that unless you do, Phil, I don't have any exact data to hand on this, which was the first question. But I do know, it was a headline in one, I forget which paper it was in last week or the week before, that far from, with the Tory government that's in power at the moment, far from limiting immigration, despite what they may have said or set out to do, there's actually higher levels of immigration into the UK than there have ever been before, which in the end is going to drive that supply and demand imbalance. Are there any particular locations that you feel it's impacting more than others, or is it just generally across the board, Phil?
I was going to say, it generally is across the board. For the net migration, as you say, it was highlighted last week. I think it was sort of in excess of 600,000. An all-time high, and that makes up. We've seen, I think that includes overseas students, it's all immigration. And that's something that we've seen a return of. Obviously, in the pandemic days, the students and overseas students, had quietened down and weren't quite such a force in the market. It's fair to say that the appetite to return back to the UK for study is certainly. And
overseas students are always great tenants because they often pay a year up front, don't they?
They do, and a lot of it's not uncommon for overseas students also to be sponsored by their government. So they have good sponsor.
Good tenants.
Financials, So actually, they pass the referencing again on that on their credits.
So before we move on to the example of the sort of development that we're very keen on, something that we're launching at the moment. Just talk us through this, Phil. Obviously it's pretty clear just glancing at it. It shows how quickly things are renting out. But this attached slide really is just a snapshot, I suppose, of just a handful of
different developments that we've had experience on in the last couple of weeks, really, I suppose. We had a scheme in Ilford. Again, for us, we've found that, the rental comes to the rental market, and, believe it or not, that within just over 1.5 days and an average, these rentals are, being uptaken. And, it's a mixture. I mean, that's a prime example. We've had some doctors, we've had some families, we've had all sorts that have shown appetite. And we have a scheme in Hayes again. It was very popular for the Heathrow and the logistics and the works around it, but obviously got the Queen Elizabeth line as well, which allows people to commute into town very easily. Again, for the 1-bedrooms, sort of a 4-day sort of turnaround, really, from collecting keys to finding tenants. With the 2 beds just been a shade over a week. But again, but these are prot schemes that have been purchased off plan. And by the time they've come for delivery, the estimated rental values we're achieving are over 10% more than what we first set out for.
Absolutely.
And it's standard. The similar sort of trends right across London. I mean, Maida Vale, we've got a scheme there which we've just had a number of renewals come through, and all of them have secured an in excess of 10% rental increase, and we're finding that tenants are remaining in the properties and absorbing the rental increases, probably not wanting to get into the rat race of finding new property. And we're finding
there's just, as we've seen, there's just nothing out there, is there? If you're in a good flat, you want to stay. I have a flat in Deptford, and we've just had a almost 20% rental increase which probably shows I was renting it out for too little beforehand. But again, it just, the tenants were happy to increase the rent because they didn't want to go out and find anything else. So
and also, I mean, what we're finding with the rental increases as well is, someone asked the question about how do we control it and regulate it, but often when we would go to a tenant for a rental increase in 12 months or whatever, it was always negotiating with the tenant and the landlord as such to where that level thing. But actually, tenants are expecting rental increases actually at the moment. It's not that they're anticipating a rise on any renewal. So I mean, it's just a very hot market.
It's a factor of the market. Absolutely.
I mean,
sorry, Phil, carry on.
I'd say we've got a block in Uxbridge, which again is historically rented always very well. But again, for the rentals right across that whole portfolio, 18% just over as a rental increase.
And what I find quite interesting about this, just to come back to that point about value, and hopefully we'll be able to demonstrate this in a second, is that clearly London remains not a cheap market to get into, right? That, be completely upfront about that. But it's not. It takes a little bit of cash to get into London, but but what's interesting is that thanks to these rental increases that we're seeing, that the yield percentages that people are now able to achieve in London have increased dramatically. So historically, certainly really certainly up until rents started climbing quite quickly a couple of years ago, you were looking in zone 1. I mean, you were lucky to get 3%. That's the reality, or less, zone 2, and then in
less than that, yes.
Yeah, exactly. And even in a sort of zone 5, zone 6 location, you probably only get 4 to 4.5 maximum. Whereas now there is an extra 1 to 2% on top of those numbers fairly, comfortably if you buy well. So that brings me on to so we're launching at the moment a development called Goldfinch Apartments in Hendon Waterside. And I think this is a fantastic example of the sort of thing that really works, that demonstrates those yields, that does it at such a low risk. In this world that is a bit topsy-turvy and a bit economically up and down in all the various different marketplaces that are out there, something like this provides, ultimately a rock steady, rock solid opportunity for you to put some money in, generate a good yield, and over the longer term do some pretty, we would expect some pretty good capital appreciation. So I don't know how many of you guys will know Hendon, but it's situated in North London. I think it's fair to say that the transformation that we have seen throughout, the last, well, as you can see, since the war, heavily bombed in the war, rebuilt in a really quite unattractive style, which then, of course, went really out of, was not in good shape. I think it's fair to say was not a very popular place to live, was mostly derelict. And then 2011, Barratt started building Hendon Waterside, which is we're talking about thousands of units here, a long-term project that won't be finished until 2029. So we are, this is part of a huge master plan that is transforming the area. But what you'll see here is this photo in the top right, is that what's really interesting about it is that it is not only, as you'll see in a second, the transport links excellent, it's also built adjacent to the Welsh Harp Reservoir. You've got parkland opposite. So it's a genuinely very pleasant place to be. So as you can see, we are north central London here. We're east of Wembley, which you can see down the bottom left, west of Golders Green. And from a transport link perspective, exceptionally well connected, moving, so you can get to, you can get into St Pancras, King's Cross, you can get into Waterloo or London Bridge. So you can get into places of employment really, really simply, within probably door to door, 20, 30 minutes, depending slightly where you're going to go. So with, where the market is now, and Phil, you already mentioned the sort of the advent of people working from home, there are plenty of people who will do Monday, Friday, without having to travel. But equally, there are a lot of people going back into the offices regularly too. So somewhere like this, where it is really accessible to get into the centre of the city, to your place of employment, but you can actually come out, you can get a bit more for your money, and you're on the water, and it's just a very, very pleasant place to live.
I think that's one of the.
We published a post yesterday on our social medias about regeneration, social media channels about regeneration and the effect that being part of a sort of a master planned community like this has on your returns as an investor. So since 2011, the average price, the average UK average is 53% in terms of values increasing. London 88%. Hendon Waterside has gone up from the point where they first launched the first 1 and 2 beds and so on in the development, when it was surrounded by some pretty awful derelict property, gone up 132%. We're still 6-7 years away from the end of the road, as it were, in terms of the last units being built, handed over and lived in. And so, we are expecting, Barratt are expecting some fairly significant growth over the next 5 or 6 years as well. And so even though clearly, we'd all have liked to have bought in 2011, looking at those numbers, I certainly would have done, but there's still plenty of it, plenty more to come. This is obviously a sort of a mix of CGI and real. The block that we're involved in here, Goldfinch Apartments. So we are, it's one of the last blocks that will have any form of direct sort of water views or unobstructed water views, as long as you get the right unit. You've got the high street immediately behind, the Hendon Central, the Northern Line is up this way. So yeah, and across here you've got some parkland and spaces to walk the dog and get out into a bit of greenery. So a really exceptional location, fantastic development, already home to over 1,000 people in terms of handed over units and property. So yeah, very, very interesting. So there you go. That's a view one of the 5th level apartments. But to give you an idea, this is being built as we speak. It's 12 months away from handover. It will hand over in June next year. It's a 10% down payment now, 90% on completion. But what's really interesting about this is that it is coming back to you, Phil, and the yields, is that a 1-bed here, give or take, is £400,000. But we are expecting the best part of £2,000 a month on this. And so, you know, those are sort of, you know, that equates to anywhere between a 5.5 on a 1-bed, you know, just under 5.5 to almost 6% yields, which are just really, you just aren't used to getting in London. And so from our point of view, from an investment standpoint, given the demand for property that we know, because how quickly these, you know, the preceding units that have been built here, how quickly they've tenanted or been occupied, and its connectivity. I meing, it's not something that should have a problem renting, I would say, Phil.
No, I mean, it's, you know, the location's great, and as you say, it's the infrastructure, being able to get into the city quickly, but having that sort of, you know, the best of both worlds is, you know, is really what tenants are looking for.
Yeah, absolutely.
They will rent out very well.
So we've got a whenever we're working on a project, we do what we call cash flows in-house, which is designed to show the sort of numbers that you will need to get into a property, whatever that property is. You know, whether we've got something in Manchester, Birmingham, or London, we can produce one of these for you as a potential investor into that site. So just to talk you through, because obviously what I did, oh, lost it again. I don't know how I've done that. There it is. On the invite, it did promise a sort of a walkthrough on some typical numbers. So this is at random a unit 182 at £403,000, which is a third floor 1-bed, 551 square feet. Every single unit has some form of outside space. This is a balcony. As you saw from the previous slide, it's 10% down payment and 90% on handover. So your initial, for a unit at £403,000, your initial payment is going to be £40,000 300 plus some legal fees, minor disbursements. There is a reservation fee which would be refunded to you upon exchange of contracts. But what this essentially means, and this is assuming, as I would imagine most of us are on this call, non-UK residents, and the fact that you might already own another property. It includes stamp duty, it includes various sort of best case estimates for mortgage broker fees, those sorts of things. So to give you an idea, your total investment here would end up being about £175,000, £180,000, of which initially you would need what, £44,000, including all costs. The mortgage rates is an interesting one, because we've obviously referenced the fact that interest rates have risen over the past, particularly the past 6-9 months. Can't quite believe we're moving into June. I keep thinking we're still in Q1. The idea behind these cash flow documents is to give you an idea of what your mortgage sort of repayments will be, what the numbers on a monthly basis will look at. So what I would stress is every single person will have slightly different sort of options available to them, because what the banks and our partners, IPFG, and from a mortgage perspective would be to look at what your situation is and recommend the best, and what property you're buying, and recommend the best loan for you. So we're quoting, I've just quoted 6.5% here over 25 years on an interest only basis. So assuming then on the right hand side that you secure a £2,000 income, there's some service charges which is related to the size of your flat. We've got £2,000 roughly a year on the 1-beds. Now, Phil, this is a good point probably to ask. Your fee here, which we've got down as 10% plus VAT, which effectively makes it 12. What does that include?
So that's obviously for our management fee, which is comprehensive full management. So
right. Including finding the tenant, all that sort of thing.
Exactly that. So if we find the tenant, we do obviously do the advertising, do the viewings, we would do the references, the legal contracts, you know, we would register deposits, do the government right to rent, collect rentals, send statements, deal with maintenance, frequent property inspections. You know, it's all encompassing, and access into our portal as well. So at any point as a landlord, you can gain and see where your property is and where all your documents are, as well as allowing that service in for tenants as well.
Yeah, perfect. So what this then, sort of finishing this off, what this then gives you is based upon these mortgage sort of parameters, gives you a mortgage repayment figure. So on an interest only basis, even with a 6.5% loan, if you buy the right property, you should still be, I mean, this is interest only, the dynamic changes if it's a repayment, but you should sort of still be able to run that neutrally. Just a word on how we calculate these sort of returns. That is based upon, I think, Phil, you had on your sheet earlier, 18% growth for Savills quoted for London over the next 4 or 5 years.
Yeah,
they were also quoting 19.9% growth for London in that same period. So we've used those numbers and extrapolated forward the potential returns. But obviously, what I would stress and what we as RPA are here to do is to provide advice as to what is the best thing ultimately to achieve your goals. It might be that London doesn't work. It might be that you want to split £175,000 into 2 properties. It might be that actually, you know, what you're after really means that London is the best thing for you to buy. So we're here to help provide that process, but hopefully that's been a useful breakdown of the sort of costs and so on that are involved in this. And just on that, with RPA, the idea behind it is that we are here to help you every step of the way. So that's providing advice as to where and what might suit your goals better, helping you establish what your goals are, because often, in my experience, people are a little bit unsure about actually what they're trying to achieve. We can hold your hand throughout that process. We have partners on the mortgage side who can provide that part of the job, as it were. And then, of course, Phil and Brick on the lettings and management side of things. I mean, Phil, is there anything else just you wanted to add in terms of your services? I know you just briefly covered that, but is there anything else you wanted to mention?
Other than the fact that, typically speaking, obviously for a lot of clients for RPA will be overseas. So again, we offer a sort of highly experienced with non-UK investors, and we're very up to speed with like the non-resident landlord status, and we'd walk through the application with your clients and handhold them all the way through the process.
Yeah, perfect. And really, just to round off, and what I would encourage, please do any questions you have for us. Excuse me, I'm aware that we're 45 minutes in, and so people probably want to go about their Wednesdays in peace moving forward after this. But if you do have any questions, please do put them in the box, and we'll do our best to answer them as best we can. But just quickly, I do. You know, buying property and investing in property, it should be simple, and simple is better in terms of the types of asset that you should be buying, because if you can't work out why something is priced how it is, or why someone's giving away all sorts of freebies, or you know, it's best to not buy that property. The best properties are ones that you look at and go, even if you don't want to live there, you can see why somebody else would, i.e. it's, in this case, for example, it's close to places of employment, it's on the water, it's a beautiful site, etc., etc., etc. There are a couple of things you can think about to mitigate against sort of high repayments of interest rates. The pound remains cheap. Obviously, inflation came down, not as far as people wanted it to come down, but it came down to 8.7%, I think it was the other day. And so that suggests that as inflation comes down, we would expect the pound to strengthen over. Yeah, I mean, this will take it'll take, you know, months and years for it to happen. But if you are buying property at the moment, the pound is still cheap. And so to take advantage of that and potentially maybe it's an extra 10% in, 5% in to help reduce those monthly mortgage costs, that is something that you can think about. Work with the right developer. A developer like Barratt are, you know, gold from that perspective. You know, they build what they say they're going to build. They're the biggest developer in the UK. 17,000 homes a year is what they deliver, and their major market is local buyers. Most of their property, 80% of their property, is sold locally, rather than the sort of stories you might hear about doing what we're doing here, talking about overseas buyers buying up entire sites. If you've got local demand, it's the best indicator for something that is A, the right price, but B, also something that will rent well and do well in the future when you come to sell it. So yeah, just in the end, well, I suppose what I'm trying to say, Phil, is be sensible. Don't try and reinvent the wheel, and just buy something that ultimately, you know, it should be really logical as to what and why you're buying ultimately. Got a question in terms of charges, and we've tried to. If I go back to the so are there any charges for buying like in Dubai? So I guess, like myself, we've got a Dubai resident asking the question. It's come through as anonymous, so unfortunately I can't name check you. There are a couple of fees involved, which I say fees, they're more taxes than fees. The big one being SDLT, stamp duty, land tax, which would be less if you don't own any other property. It would be less if you're in the UK, if you're resident in the UK, but that's probably not relevant to most people on this call. And that's the single biggest chunk that you will pay outside of the actual cost of the property. It's also banded, so at the cheaper, lower, at the sort of lower, at 250k, it's a lot lower than at 400k or 600k, for example. So again, this is sort of the advice we can provide, but that is a mandatory cost that you have to sort of unfortunately sort of take on the chin. There's no fees to us. We're an agent. We earn our fees from the developer upon successful sale. The only other fees, I mean, in terms of being involved, so Phil, we briefly talked about it just now. There's your management charge. There's solicitors' fees. This is, I mean, it depends again slightly which solicitor you might use, but £2,000 give or take either way is probably a fair estimate on the cost of that. There'd be if you use a mortgage broker, they would charge you something. There's valuation fees. There's almost certainly a lender arrangement, or there definitely is a lender arrangement fee. But these are sort of educated guesses as to what they might be, because it does depend who you use and what offer or what mortgage offer you choose to take. Well, how does things like home insurance work, Phil? That's something that we don't have that on here. But if you've got a furnished apartment, it's probably something that you would want to have in place.
Yeah, most certainly. So I mean, with these apartments, the sort of the insurances, the buildings insurance is all incorporated within the service fees. So with the block service fee, so that's your buildings insurance. So as a landlord, we recommend obviously to have insurance on your fixtures and fittings and furnishings. So again, as a sort of a minimal sort of level cover, it's not particularly costly, but it does cover, sort of like public liability and such. So like, if someone harm themselves or trip over something. But yes, as I say, that's something that we offer premiums out on rentals and contents.
So we've got a question now about which I'll go back to this slide to help answer, the relationship between Barratt, RPA and bricks. From Avid, thank you very much for the question. So Barratt are the developer. In simple terms, Barratt are the builder. They're the company that's selling the apartments. RPA, we're an agent, we're an independent agent that works not just with Barratt. We're talking about Barratt today because it's London and it fits the topic, and we're newly launching it and we want to talk about it. But we're an agent ultimately, so we obviously provide the go-between between the developer and any investors that want to buy. And Brick provide, are our preferred, it's the company, if you like, our preferred letting and management provider. So there's no absolute requirement to use Brick or any of but ultimately we would strongly suggest you do, because we believe in the service that Philip and his team provide ultimately, many happy clients would attest to that. That was the time. We are 5:52. Well, look, I don't think, maybe we might just have one more question come in. Good question, actually. Another, it might be the same anonymous attendee, so thank you. But does RPA get any price concessions from Barratt on this development for a bulk purchase, for instance? Look, I think the reality is when it comes to price and things like that, you saw on the previous or one of the previous slides that actually most sellers are achieving asking price on, almost achieving asking price on anything that comes to market. So it's not, we're not in a market, despite what you may have read, where there are enormous discounts floating around. There's always going to be the odd seller, the odd person who wants to sell and has to sell fast. And if you find one of those, then fantastic, you might be able to get yourself a deal. But broadly speaking, the figure there was 97.5% of prices, of asking prices are being achieved. And it's actually, it would be higher with Barratt because and this development, because of the quality of the product and location, and people want to live there. For a bulk purchase, if someone wanted to buy more than one unit, then we would definitely entertain conversations around that. But realistically, we're sort of looking at 3 units or more to be considered as a bulk purchase. But look, I think, Phil, we are 5:54, 54 minutes in. We probably ought to call that a day here and now. So what I would say is thank you very much to everybody for attending. Really appreciate your time this afternoon. You will definitely be reached out to see if we can help further from whoever it was that invited you. We'll be in touch, and if we can help in terms of whether that just be conversations about processes or particular developments or strategies or anything like that, we'd be more than happy to do so. And likewise, Phil, of course, I'm sure you would be also willing to talk to anyone that has either property already in London that they might, or the UK, that be looking to rent out. Or
exactly that. Any rental questions or any rental advice anywhere in the UK, where you should say whether it be an existing portfolio or one to build. I'll be ready.
Or things they may have bought off plan that are still coming through.
Exactly that. So we'll be more than welcome to have a chat.
Very good. Thank you very much, everybody. Very much appreciate your time. We will speak soon. Thank you very much. Cheers.